starting with number 1, not having a priority for your money. Babies have to crawl before they can walk, before they can run. When it comes to money, a lot of people are running before they even learn to crawl. In the financial world, if you have credit card debt or payday loans or high interest types of debt, you are in the crawl phase. And when you have this type of high interest debt, you should not be worried about trying to invest your money in the stock market. You should not be worried about trying to save a whole bunch of extra money. Your sole focus needs to be paying down this credit card debt. So, if you have high interest debts and you're worried about investing in stocks, your priorities are in the wrong place, the first thing you gotta do is pay down this credit card debt, because your credit card debt is gonna cost you 15, 20, 25, sometimes 28% a year in interest. When you invest your money in the stock market, well, the average stock market return is 10% a year. 10% is smaller than 20%, so pay off your credit card debt first and don't worry about doing all the other stuff. Crawl before you can walk. When it comes time for you to walk financially, you gotta have at least $2,000 extra put aside in a separate bank account just to protect you against emergencies. There's not $2,000 for a car, $2,000 for a watch, or $2,000 for a security deposit. This is an extra $2,000 in case you lose your job, in case your kid breaks a leg, or in case your AC goes out. You have an extra $2,000 put aside just in case. If you don't have this $2,000 put aside, you should not be worried about investing in stocks. You should not be worried about trying to flip real estate or investing in real estate with zero money down. What you need to be focused on is saving this $2,000 as fast as possible. Work to save some more money by living smaller. Work to earn some extra money by working extra hours, but you gotta get this $2,000. And then when it comes time for you to run financially, this is now where you're actually acquiring assets. You're investing your money. And if you don't have any assets, listen, you don't gotta worry about asset protection. You don't gotta worry about building these tax strategies. You don't gotta worry about doing all this legacy stuff because you have no assets to protect yet. It's one of the funniest things when someone's got $44 in their bank account and they're talking about tax strategies and how they can pass down their wealth. You don't have any assets to pass down yet, so get the assets, then worry about the asset protection. Number 2 is thinking your credit score is what makes you rich. There's an entire industry of people, especially on the internet, that love to sell you this idea of how having an 800 credit score is gonna open up the opportunity for you to build all this wealth. And unfortunately, this industry is selling primarily to poor people, people who don't have money, people that are struggling, and people that don't have a good credit score. Here's the reality. Your credit score really does not matter. All it is an indication of how good you are in paying your bills, and it doesn't even do the best job at that. Your credit score is not an indication of how wealthy you are. Your credit score is not an indication of how many assets you own. Your credit score is not an indication of how much money you have in the bank. Your credit score is not an indication of what degree you have. Your credit score is not an indication of how good your job is. All your credit score tells you is how good you've been at paying off your bills. And again, it hasn't done the best job at even explaining that. That being said, can a better credit score help you? Potentially, but here's the part that so many people are doing wrong. Remember, this credit score helps people buy more debt. And if you're using this debt to buy liabilities, this doesn't do you any good. You got an 800 credit score, but all you're doing is working your job so you can pay off your car, so you can pay off your watch, so you can pay off your house, so you can pay off your fancy vacations. That 800 credit score shows you, hey, you're making your payments, but yeah, you're broke. This is where, yes, a better credit score can help you get a cheaper mortgage, but that's really it. If you want to go out and buy a car, buy it cash. Your car is a depreciating liability. It's going to lose value as soon as you put the keys in the ignition. Your car is going to need maintenance. Your car has a limited time span. So why pay interest on something that's losing you money? Buy a car with cash. Maybe you can't buy as nice of a car, but buy it with cash. You should not be using your credit score to finance your vacation to Cancun, and you should not be using your credit score to pay for your wardrobe. So, can your credit score help you when it comes to buying a house? Sure. But you don't need a good credit score in order to actually build wealth. Number 3 is living fake rich. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. And Robert Kiyosaki, author of Rich Dad Poor Dad, famously said that the majority of people are working to buy liabilities that they think are assets. And so what does that mean? The majority of people are trying to look rich. We want to have the big house, we want to have the nice car, because when you get the nice job, you want to show it off. Because you got a nice job, you got to have the BMW, you got to have the nice apartment, you got to have the nice penthouse, you got to have the nice big house with 4 bedrooms and 2 baths because you've earned it. But here's the reality. What you're doing many times is you're making everybody else rich except yourself. As soon as you make money, your money is going here. While what wealthy people want to do is they want to own the assets that are putting money in their pocket. Your BMW is not putting money in your pocket. You're putting money in BMW's pocket, and you're putting money in your bank's pocket. Your house, for many people, is not putting money in your pocket. You're putting money into your mortgage company's pocket. You're putting money into your insurance company's pocket. You're putting money into your property taxes pocket. You're putting money into the maintenance pocket. You're putting money into the utilities pocket. Month after month after month after month, and then you have to hope that your home is going to go up in value, and what we know is that houses don't always go up in value. I got my real estate salesperson's license almost a decade and a half ago now, and one of the things that you learn when you are a real estate salesperson is you want to learn how to sell a house. But what you're not selling is a house, you're selling a home. And more specifically, you're selling the biggest investment that most people will ever make. And when I can tell you that your home is one of the biggest and best investments you're ever going to make, it's going to be a little bit easier for you to buy a little bit bigger and a little bit nicer because you're buying an investment for your family. You're buying an investment to build a generational wealth, to finally own the house. And your mortgage banker is going to tell you the exact same thing. This is an investment. Your house is going to go up in value. It's going to help you get rich, and it's going to help you have an asset that you can pay off and pass down to your kids. But the problem with that is, well, number one, if your house does go up in value, now your property taxes and insurance went up, so you have to make more money to make those payments. And if you don't have the salary to support the higher payments, well, you're stuck. As soon as you sign the paperwork, your mortgage banker and realtor are gone. They don't care if you make the payments or not. They just want to get their commission check, because once you sign the paperwork, they get paid. And not to mention, well, you have to pay for everything in the house for every month that you live in there, and then you have to hope that your home goes up in value. Now listen to me very carefully. I'm not against you buying a house. In fact, I think it's a very good thing for you to buy a house when you can afford it, but the key is to buy a house that you can afford. And that's why the rule that I like to follow is a very simple 75, 15, 10, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. This is all the money that you can spend on your mortgage, on your groceries, on your vacations, on your clothing, and everything in between. 15 cents is the minimum that you're investing of every dollar that you earn, and 10 cents is the minimum that you're saving of every dollar that you earn. That means you can only spend 3/4 of every dollar that you earn, and the other quarter you're investing into yourself by making yourself wealthy and by saving that money. This way now you can work to actually build wealth for yourself. And if you can afford your house in this, then be my guest and buy that house that you can afford, because now you still have the money to invest. The mistake that so many people make is that people buy a big house thinking that this house is their investment. My investment is my mortgage payment. When in reality, that mortgage payment is just making your banker richer. Because what happens when you get a 30-year fixed rate mortgage is for the first 15-ish years out of 30, more than half of your mortgage payment is going to be interest. So if your mortgage is $3,000 a month and you start the mortgage payment today, it's not half of your payment going to principal and half going to interest. If you look at an amortization calculator, what you'll see is that almost all of that $3,000 is going in interest on month 1 and month 2 and month 3. And it isn't until year 15 where half of your mortgage payment is going towards your principal balance and half is going to interest. And so these loans are front loaded, and if you refinance your mortgage, well, you start that process all over again. That's why I want you to understand how this works, and don't treat the house as an investment. Buy actual investments, rental properties, stocks, businesses as your investments. That way you can actually work to become wealthy, because a lot of people want to look rich. You're taking your money and you're buying that lifestyle. You got the nice car, you got the nice clothes, you got the nice house, but you have no actual wealth. I want you to actually become wealthy, that way you can have the freedom for yourself. Now, if you're an investor or want to become an investor, again, my team at Briefs Media publishes a free daily report called Market Briefs, where we break down what's happening in the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and when you join, you're also going to get an investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. So if you want to get this investing masterclass and Market Briefs, all you have to do is click the link down in the description below. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.